If you're over 73 and you've got more than $1 million sitting in a traditional IRA, the government is about to force you to take money out, whether you need it or not. And what you do with that money could be the difference between a $0 tax bill or a $10,000 one, or anywhere in between. So here's exactly how to decide. Now, a quick refresher before we get into the video. An RMD, or required minimum distribution, is the minimum amount of money that the IRS requires you to pull out each year from tax-deferred accounts, like a traditional IRA, 401k, or 403b, once you hit the RMD age. Now, the IRS lets that money grow tax-deferred for decades, and the RMD is how they finally start collecting on it. The amount is based on your account balance and IRS life expectancy tables, and it generally gets added straight to your taxable income for the year, with one exception which we're going to discuss later in this video. So once you've taken it out and paid whatever tax is owed, that money, it's yours. That's where the real decision starts. And for most people, almost every RMD decision falls into one of three buckets: spend it, reinvest it, or gift it. None of these are automatically the right one. It depends on whether you actually need the income, what tax bracket you're in, and whether giving is part of your plan. So let's first start with the simplest one. If you rely on your RMD or other IRA withdrawals to cover everyday living expenses like housing, healthcare, travel, general lifestyle costs, then spending it is almost always the most appropriate choice, and there's no need to overcomplicate it. Here's the tax piece though. The distribution is taxed as ordinary income, and if you're not careful about when and how much you pull, it can push you into a higher tax bracket than you expected. I call this bracket creep. So say you're already close to the top of the 12% bracket from Social Security and your pension. A large RMD can shove a chunk of that income into the 22% bracket instead of the 12. And there's a second sneakier trap, which is that Medicare IRMAA surcharges. Because IRMAA looks at your income from 2 years prior to determine your Medicare Part B and D premiums. A big RMD this year can mean a noticeably higher Medicare bill 2 years from now. And a lot of retirees get blindsided by that letter in the mail. So if you're in the "I need this money to live on" camp, the planning question isn't whether to spend it. It's seeing whether there's a way to avoid a higher tax bracket or Medicare premiums. And sometimes there's not, but that's okay as well. There's no reason to reduce your lifestyle just for taxes, assuming that you can afford that lifestyle, of course. Now the second option, and this is one that surprises a lot of people, is that many retirees find they don't actually need their full RMD to live on. Social Security, a pension, maybe some other income sources are already covering expenses. And if that's you, remember the RMD is mandatory regardless of need. You have to take it, pay the tax, but then what? The common move is to reinvest the after-tax proceeds into a taxable brokerage account, keeping the money working instead of just sitting it in a checking account. Here's what changes tax-wise when you do that. First, you're shifting that money from tax-deferred treatment to taxable treatment. Inside that IRA, it wasn't taxed year to year. In a brokerage account, however, dividends and any capital gains that you realize are taxable going forward. But keep in mind that long-term capital gains and qualified dividends are taxed at lower rates than ordinary income. So second, and this is a real silver lining, assets in a taxable brokerage account get a step up in basis when you pass them to heirs. Money that's left inside an IRA, it does not get that treatment. Your heirs inherit your tax bill along with the account. So for some clients, deliberately moving RMD money into a brokerage account each year is actually part of an estate planning strategy. It's not just an investment one. So third, once it's in a brokerage account, you have more flexibility. There's no more forced distributions or rules like you have with the IRA anymore. So if you've got more than you need, reinvesting keeps that money growing for your future goals or for whoever inherits it. You're just trading one set of tax rules for another. Now here's the one that gets the least attention, and frankly, it's also the most misunderstood, which is gifting it. And this is where I want to slow down because there are actually 3 very different ways to do this, and they have 3 very different tax outcomes. So first, path 1, the qualified charitable distribution, or QCD. If you're 70 and a half or older, you can transfer money directly from your IRA to a qualified charity, up to annual IRS limits. That distribution counts towards satisfying your RMD, but, and this is the important part, it is also completely excluded from your taxable income. It never shows up as income on your return at all. Compare that to option 2, which path 2 is to take the RMD yourself, then write a check to charity. This feels like the same thing, but tax-wise, it's not even close. When you take the RMD, the full amount hits your taxable income first. Then, if you itemize deductions, you can deduct the charitable gift, but only if you itemize and only up to percentage of AGI, and there's also some other rules as well. So if you take the standard deduction, like most retirees do nowadays, since the standard deduction nearly doubled a few years back, you get no offsetting benefit at all. You pay the tax on the income, and you don't get the deduction to cancel it back out. So the QCD is excluded from adjusted gross income. The cash gift raises your AGI first, and then maybe gives you some of it back through a deduction, and again, only if you qualify, and all these other rules as well. And because a QCD is excluded from AGI, it can also help you avoid that Medicare IRMAA surcharge that we talked about earlier. So one critical rule here though on the QCD, the money has to go directly from your IRA custodian to the charity. If the check comes to you first, and then you deposit it and donate it, it does not qualify as a QCD. You've already blown that tax benefit, unfortunately. Now last, path 3, is gifting to family instead of charity. Now this is a totally different animal because family members, they're not qualified charity, so QCD rules, they don't apply at all here. If you want to help your kids or grandkids with RMD money, you take the RMD as ordinary income first, you have to pay the tax on it, and then what's left you can give as a personal gift. Gifts to individuals, they're not tax deductible to you the way that charitable gifts are either. So the main thing to watch out is actually the annual gift tax exclusion. As long as you stay under that per person per year limit, there's no gift tax reporting required at all. If you go over it, you would need to file a gift tax return, though for most people that just eats into a much larger lifetime exemption rather than triggering an actual tax bill. But do remember once again that you are still the one on the hook for paying the ordinary income tax on the RMD. So to recap this comparison, a QCD keeps the money out of your income entirely, and it also can satisfy your RMD or part of it. Gifting cash to charity puts the income on your return first and only offsets it if you itemize. And lastly, gifting to family, it puts the income on your return first. There's no offsetting deduction at all. It's simply a personal gift after tax. At the beginning of the video, I said that it's possible to pay $0 on your RMD. So let's look at a quick example. So we have a theoretical retiree, and they have a $40,000 RMD. She didn't need the income because Social Security and a pension covered her expenses. And she's given a significant amount of money to her church every single year. So instead of taking the $40,000 as income and writing a check afterward, she sent the entire RMD directly from her IRA to the church as a QCD. So it satisfied her full RMD requirement, and none of it, $0, showed up as taxable income. It's the same generosity, the same amount going to a cause she cares about, but it's a dramatically different tax outcome. So which of these 3 is right for you? It really comes down to 3 different questions. The first, do you need the money to live on? So if it's yes, spending it is usually the most practical path. Just watch the bracket creep and the IRMAA timing that we discussed. The second question is, do you have more than you need? If yes, then often reinvesting the surplus in a brokerage account keeps it growing. And depending on your estate plan, it may set your heirs up with a better tax outcome down the road. So the last question is, are you charitably inclined? If yes, a QCD is often the most tax efficient of all three options, especially if you've already taken the standard deduction and you won't get a benefit from a regular charitable deduction, because of course you have to itemize. But here's the thing, most people, they don't pick just one option. They spend a portion, they reinvest a portion, and they gift a portion. There's no rule that says an RMD has to go entirely into one bucket. If this video is helpful, the most useful next step is figuring out which of these three or which blend of these three actually fits your numbers. So there's a link below to grab a free introductory call. There's no pressure at all. But otherwise, thank you so much for watching. Please subscribe to the channel and watch out for the next video.